All right, welcome back to The Explainer. Today, we are diving deep into the financial world of a healthcare giant, Elevance Health.
So let's just get right to it. The big question, the one every single investor wants to know is this thing on sale? Is there some hidden value here, a potential bargain just waiting for us?
And to figure that out, we're going to have to put on our detective hats. We're going to dig into the data, follow the clues in their financial reports, and see if we can uncover what's really going on. Okay, let's get into it.
All right, so first things first, we need to get to know our subject. Who exactly is Elevance Health? What do they do? So here's a quick snapshot, kind of like a high-level briefing. This is based on data from October 17th, 2025. You can see the stock price right there, some key details, headquartered in Indianapolis.
Okay, let's zoom in a bit on the fundamentals. The company is Elevance Health. Ticker is ELV. And as you can probably guess, they're a huge player in the healthcare sector. But more specifically, their whole game is healthcare plans. Now that's a really important detail to keep in mind because that's the world they live in.
All right, now for the fun part, the part you've been waiting for. It's time to check the vitals. Let's get into the numbers and see what they're trying to tell us. Okay, so this is like the dashboard for the company's health. Right off the bat, that market cap, over $78 billion. That is huge. Now look at the PE ratios. That's price to earnings. The trailing PE is almost 15, but the forward PE is down around 11.5. What does that mean? Well, it suggests that Wall Street thinks earnings are going to grow. And then there's the ROE, return on equity, sitting over 12%. Basically, that tells you how good they are at making money with the cash that shareholders have given them. It's a key sign of good management. Wow. Okay, let's just start at the top line. Take a look at this number, $189 billion. That's their total revenue. I mean, a number that big just screams at you about the massive scale we're talking about here.
But, okay, hold on. When you dig a little deeper, you see this. A pretty big drop, over 21% in year-over-year earnings growth. Now that is an interesting clue. It's not necessarily a deal breaker, but it's definitely a potential red flag we need to file away as we keep digging.
Yeah, that earnings drop is a really important piece of this puzzle. To understand what's going on, we got to go deeper. It's time to open up the evidence locker. I'm talking about the core financial statements. Okay, first piece of evidence, the income statement. Think of this as their report card for the past year. Yep, there's that massive $189 billion in revenue again, and after you pay for everything, all the costs and expenses, they're left with a net income, a profit of about $5.4 billion. Not bad at all.
Next up, the balance sheet. This isn't about performance over time, it's a snapshot. What do they own and what do they owe right now? So you see total assets of almost $117 billion. And on the other side of the ledger, they've got about $31 billion in debt. This gives us a really good feel for how the company is built, its financial foundation. And finally, the cash flow statement. This one is all about where the money is moving. And honestly, the number you really want to look for is right at the bottom, free cash flow, over $5.3 billion. That's the cold, hard cash they have left over after running the business and investing in its future. A number like that is a fantastic sign of financial strength. Okay, so we've gathered all this evidence, we've looked at the reports, now it's time to pull out our main investigative tool and figure out what we think Elevance Health is actually worth, completely separate from whatever the stock market is saying today.
And to do that, we're going to use something called a discounted cash flow model, or DCF. Now I know it sounds super complicated, but the core idea is really simple. It just says that $1 in your hand today is worth more than a promise of $1 next year, right? So what this model does is it tries to predict all the cash the company is going to make in the future, and then it discounts all that future money back to figure out what it's all worth in today's dollars. That final number, that's what we call intrinsic value.
Now, of course, any model like this is only as good as the assumptions you feed it, so let's be transparent about what we're plugging in for our main scenario. We've got a risk-free rate of 4%. The beta is 0.59. Anything under 1 basically means the stock tends to be less jumpy than the rest of the market. And for the long-term growth rate, we're using a pretty conservative 2.5%. So we plug all that in, run the numbers, and what we get is a range of possibilities. You have to account for different futures. In a worst-case scenario, the value comes out to about $524 a share. In a best-case world, it's way up at $820. But for our purposes, we're going to stick with the most likely scenario, what we're calling the base case. And so here it is, the big number from our base case. After all that number crunching, our model spits out an estimated intrinsic value of $657.77 per share. So now we get to the whole point of this exercise. We take our number and put it right up against the actual market price. This is the moment we've been building up to.
And well, this is the moment of truth, isn't it? On one side, you have our calculated value, based on the financials, almost $658 a share. And on the other side, you have what the stock is actually trading for today, around $349. I mean, that's not just a small difference, that is a massive gap.
So what's the verdict? Well, based purely on this DCF analysis, the conclusion is kind of staring us in the face. The model is screaming that this stock is significantly undervalued. The price the market has put on it just isn't anywhere near what our calculations say it's worth.
And that leaves us with one final, very interesting question to chew on. Our whole investigation, all the data, it all points to some serious hidden value here. The numbers suggest there's a real opportunity, but, and this is the million-dollar question, will the market ever see it that way? Will it eventually wake up and close that gap? That right there is the big unknown.